There's one specific tax strategy that saved our financial planning clients many thousands of dollars over each of the last several years. And if you're trying to manage your taxes this year, this might be a good option for you too. It has to do with charitable giving. Usually when we think about charitable giving, we think about pulling out our wallet and dumping some cash in the collection plate at church, or maybe writing a check to the American Cancer Society, or stopping by your local Goodwill and depositing your old household items and old used clothes. It can work like that, but it doesn't have to. You can also donate your investments, and there are a couple really compelling reasons why you might want to consider doing so. The first reason this is so compelling is that if you give an investment to charity, you don't necessarily need to sell it first. It could be a stock or a bond or a mutual fund or any other kind of fund. So for example, let's say that 10 or 15 years ago, you came into some money and you took $100,000 and deposited it into a taxable investment account in your name. And you bought 1,000 shares of a mutual fund for $100 a piece. Since then, let's assume that the value of the fund has grown from $100 a share to $300 per share, and your account is now worth about $300,000. Well, if you decide that you want to give $10,000 this year to charity, you want to use that investment to do it, if you're going to give cash, you have to sell shares of the mutual fund first. And at $300 per share, in order to raise $10,000 in cash, you'll need to sell between 33 and 34 shares. And in doing so, you're realizing some long-term capital gains. You bought these shares at $100 per share. Now they're worth $300 per share. When you sell them at $300, you're realizing a long-term capital gain of $200 per share. And if you're selling 33 1/3 shares to raise $10,000, that means you have a long-term capital gain of about $6,667 you're going to need to pay tax on. Instead, you could just give shares of the mutual fund directly to your charity of choice. If you sold the shares to raise the cash, you'll be paying long-term capital gains taxes on that $6,667. Most of us will pay 15% on those long-term capital gains. If you're a lower income person, you might pay as little as 0%. If you're a higher income person, you can pay as much as 20%. The majority of us are going to be paying 15% on those long-term capital gains, plus potentially state income taxes depending on where you live. Now, 15% of those long-term gains you're realizing, $6,667, works out to about $1,000 that you'd owe to the IRS just by selling the shares of the mutual fund to raise the $10,000 of cash that you want to give to charity. So if we make a $10,000 gift to charity, whether it be cash or investments, how valuable is that actually to us? Well, it depends on what your marginal tax bracket is, and you have to be itemizing your deductions in order to benefit from it. Now remember, every single year when we file our taxes, we have a choice between listing our itemized deductions, filing Schedule A and itemizing, or taking the standard deduction that everybody is entitled to. This year, the standard deduction is going to be $15,750 for single filers, $31,500 for married people filing jointly. So at the end of the year, you add up all your itemized deductions. If they're less than those amounts based on your filing status, you just skip Schedule A, don't itemize your deductions, just take the standard deduction. And if that's you, giving an extra $10,000 to charity is not going to benefit you because you'll be taking the standard deduction anyway. If you're itemizing your deductions and you give $10,000 to charity, that's an additional deduction that reduces your taxable income and you will benefit from it. Now, our itemized deductions, there are several of them. The three main ones are state and local income taxes paid. That could be on income, it could be on real estate taxes, or perhaps sales tax. It's mortgage interest, and it's charitable gifts. There are a few others that are a little bit less common. So at the end of the year, you add up all your itemized deductions. If they exceed the standard deduction, then you itemize. The $10,000 gift to charity as an itemized deduction helps you at the rate of your marginal bracket. So if you're someone who's going to itemize your deductions and you're in the 24% tax bracket, by giving $10,000 to charity, you'll save $2,400 on federal taxes, and perhaps more than that if you have a state or local income tax too. If you're in the 32% bracket, you give $10,000 to charity, it'll reduce your taxes owed for the year by $3,200, and so on. So what if you don't have a charity in mind that you want to donate to? Maybe you don't go to church, or you don't have an organization that you really want to give such a donation to. Well, that brings me to the second part of the strategy, and the reason that I'm so fond of it in general, and that's using donor advised funds. A donor advised fund is basically like setting up your own foundation without any of the legal cost or hassle. And you can do it through any of the major brokerage firms these days. So with a donor advised fund, again, you can open them at any of the major brokerage firms. They all offer them for free these days. Fidelity, Schwab, Vanguard, they all have them. You open a charitable account, you title it whatever you want. It could be the Smith Family Charitable Fund or something of the like. And then you gift assets to this new account. You get a deduction for 100% of the value of what goes into the account. Again, it could be cash, it could be stocks, bonds, mutual funds, anything the brokerage firm is willing to accept from you. At that point, the assets inside the account, remember this is a charitable account, typically they're sold immediately on the open market. But since it's a charitable account, you're not paying any capital gains taxes any longer, right? So you have $10,000, using our example, in this donor advised fund. Usually what happens is people elect to reinvest that $10,000 into something else, maybe a balanced fund, something oriented for income or growth. You have discretion. And in the future, when you're ready to make your actual charitable gift, you instruct or specifically recommend to the brokerage firm to make a gift out of your donor advised fund to your 501c3 of choice. Now, the limitation here is that it has to be a bona fide 501c3. Again, it could be your church, the American Red Cross, your local Little League, anything of the like. Also, you do not get the money back once it goes into the donor advised fund. So you make an irrevocable gift to the donor advised fund, you get your $10,000 deduction as a charitable gift immediately. At that point, the money is in the account, it does not come back. But it enables you to position the money for longer term growth and distribute it out to charity when the time is right, but front load the charitable deduction for tax planning purposes. Now, there are a couple limitations about this maneuver that you should know about. Anytime that you're giving to charity, there are limits on the amount that you're able to deduct, and it depends on your adjusted gross income. So if you give to charity too high a portion of your adjusted gross income, you might not be able to deduct 100% of your gift in that year. And if that happens to you, the excess doesn't just go away, it just carries forward into future years. So that's something to be aware of. And the limit depends on the type of asset that you're giving. Cash has a different threshold than stocks, and the type of organization receiving the donation. But in general, this is a really powerful maneuver. You get tax savings up front, even if you're not sure exactly what organization you want to benefit from the donation down the road, and is a really compelling option for a lot of people if you have taxable investments that have grown in value. If you're interested in managing your taxes throughout your retirement, make sure to watch our videos on the YouTube channel about Roth conversions and download the 5-step retirement income plan.